A very good evening to everybody, and welcome to our final session on Agri-Business Management. I have seen a few comments in the previous videos. For that, I am very grateful. I hope we can continue this journey of ours, and we are getting closer to your NFL exam. I hope all of you are studying well and revising well. And so, let us get into today's video. So, as you have seen, today's video is a bit of analysis and maths and all of those things. Of course, because this is a marathon session, I am going to start the class with the assumption that you have already studied these things, and we are going to do the basics, right? So we are going to do the top approach where I'm just going to skim through the topic so that you need to know the most important points. Now, stating that there will be some formulas, there will be some things that you will have to remember, right? So when it comes to the topic that we are going to do today, it will be financial statement analysis, right? So when we start financial statement analysis, you need to understand that it is a bit of a mathematical part. So there will be formulae, and these might be important questions, important MCQs that can be asked, right? So they can ask you they can give you the ratio name and ask you the formula, or they might give the components of the formula and ask you what is the ratio formed, right? Or they can give you values of the components in the formula and ask you to calculate the value, anything based on the toughness of the exam, right? So I truly wish that all of you have geared up for this evening session. Without further much ado, let us start today's class. Again, please download the Oliveboard app so that you will get the notifications instantly regarding all the classes that you want to attend, right? Now, so what is financial statement analysis? So if you can see here, there are two words here, that is financial and statements, right? So the two words are financial and statement. Statement is something which is presenting to you, presenting details of something to you. It can be anything. Statement of the statement of that law, statement of that theory, income statement, balance sheet, profit loss statement, anything, right? So when we say statement, it has some details pertaining to something. So when we say financial statement, so financial statement means finance. So this, we can say that it comes from the word finance, which basically means revenues and expenditures. See, one simple way to understand topics, you can cut the words into two things, so it becomes very simple in your head. You just have to think about, okay, financial statement. Finance means we're talking about revenue and expenditure. Statement means detailed explanation of these things. So what are financial statements? They are nothing but a detailed explanation of the revenues, expenditures of a company, right? So under revenue, under expenditure, there are various types. Their equity might come up in the middle, right? So many other things, small specifications are there, which I am sure that you all, being ABM and MBA graduates, are very much aware of all those things, right? So with this basic definition with us, let us proceed. Now, financial statement analysis. What do you mean by analysis? We saw what is financial statement. So what do you mean by analysis? It is nothing but in-depth interpretation. This is something that I would like to say, that analysis means in-depth interpretation of whatever is there. So there's a financial statement, and we're going to analyze that, or we are going to interpret that in a very deep manner. We are going to see why these revenues have come. We are going to see where the expenditures are being made. Everything will be accounted for. We'll ask all the questions: why, where, how, who, everything related to each and every revenue and expenditure. That becomes a in-depth interpretation. So why in general sense, why do we need to do this, right? We need to do financial statement analysis because when you own something, right, when you own even a normal machine or a normal electronic device, you keep checking upon it. No, see, if you have a phone, and obviously we take photos, we store videos and all, now and then you check how much storage is left. Do I need to delete some photos? Do I need to add a memory card, or do I need to use it carefully? One more example is your Gmail account. Your Gmail account, there is a line which is showing 15 GB free, and it keeps on coming. The red line keeps on moving as and when your storage increases. And when it is very near, you'll start, oh, I have to delete mails, I have to move my photos, or whatever it is, right? So what are you doing? You are doing an in-depth analysis of anything that you have. So when you own something as big as a company, won't you do an in-depth analysis of the revenues and expenditure? Because what is revenue? Revenue is, let us say, sales or whatever products, services that the company is offering, right? So from this, when you subtract expenditure, you're going to get profit of the company. Won't you want to know, as a business owner, how much profit you are making? Of course we want to know. So it's not only profit, we want to know other things, right? So from where are we getting most income, where are we losing, or where are we making the highest expenditure? Is this expenditure absolutely necessary, or is it a double expenditure? Is it going to waste? All these things we will understand when we do an in-depth analysis, right? So there are majorly a few financial statements we are going to go across. So the first one is balance sheet. So balance sheet is the most simple one. It includes assets and liabilities of a company. Here I would like to tell you, assets are always positive. Liabilities means something that is negative, right? So liabilities means which the company owes to others, right? Assets means others owe to the company. I hope this is clear, right? So assets means when other people owe the company something. Liability means when the company owes something to others. So major form of liabilities, right? I'm going to write it here. The major form of liabilities is your loans or debts, right? This is your major form of liabilities. So now what is a balance sheet? A balance sheet is a report of a company's financial worth in terms of book value. Book value means how much is present in the book or how much is present on the product, that will be entered into the balance sheet. It is broken into, sorry, this is two parts, not three. It is broken into two parts, include company's assets and liabilities. Short-term assets such as cash, accounts receivable can tell a lot about company's operational efficiency. See, asset means, again I am repeating, it's a positive thing, it's a good thing, that is which others owe to the company, right? So others may owe it in the form of cash, or it may be accounts receivable. Accounts receivable means there will be a note or there will be a contract which says that okay, in 1 month or in 2 months time this person will pay the company this much amount. That is accounts receivable. It might be receivable immediately or it might be receivable in the future, but whatever it is coming into the company, so it's a positive thing. Someone else owes the company, so we will get money, right? It can tell a lot about company's operational efficiency. Operational, yesterday we have studied what is operations. All the activities that goes into a production process are operations, right? So if these operations are very efficient, then the company can produce more products, more services. It can have a very good business relationship with each of its customers, right? Then it will be more profitable. Assets will be more, right? So we get this information from its assets. Now liabilities include the company's expense agreements and the debt capital it is paying off. See, liabilities, what are they including? It includes both the debt and the expenditure, right? So of course when it's a company, lot of expenditure will come in the form of repairs, salaries, purchasing of raw materials and all of those things. On top of that, it has to repay its loan, that is also there. So here we can in short you can take it down as assets are cash plus accounts receivable, whereas liabilities are expenditures plus debt payments, right? So these are the two things. Now what is income statement? Income statement breaks down the revenue that a company earns against the expenses involved in its business to provide a bottom line, meaning the net profit or loss. See, income statement is very, very simple. Balance sheet has assets and liabilities, right? Income statement has revenue and expenditure, right? So, on one side of the income statement, there will be revenue. On the other side, there will be expenditure. So, if revenue is more than expenditure, then it will be net profit. If revenue is less than expenditure, it will be loss, right? That I think you should know. If revenue, R is revenue, is more than expenditure, then it is net profit. If revenue is less than expenditure, then it is loss, right? So all this information is given by income statement. What is cash flow statement? Cash flow statement provides an overview of a company's cash flows from operating activities, investing activities and financing activities. See, operating activities means all your production things, like what are the decisions or what are the activities which are done in production process? Ordering raw materials, payment to the laborers, purchasing machines, purchasing repair of machines and all of those things. So when you are doing operating activities, you need to understand cash flow statement is not for at a specific point of time. It is calculated over a period. Over a time period. This can be the time period can be anything like 1 week, 1 month, 1 year, anything. So in that 1 week, how much operations have you done? How much production have you done? What is the income from that production? What is the expenditure from that production? Right? So in cash flow, there are two types of cash flows. First one, right. So there are two types of cash flows. First one is cash inflow. Second one is cash outflow. So cash inflow and outflow, they are very self-explanatory. Cash inflow means something that is coming into the company and cash outflow means something that is going out of the company. So this cash inflow is always a good thing. It's a positive thing, and cash outflow is always a negative thing, right? So cash inflow must always be higher than the cash outflow. So this cash inflow and cash outflow is present in all this operating, investing, financing, all these activities. These two components are present, and these two components are recorded and measured, and then analysis is done, whether this is needed, whether it is not needed, how to improve the situation and whatnot. Coming to types of assets and liabilities, like this again I told, this is present in a balance sheet, right? So there is current assets, intermediate assets, long-term assets, right? So cash, accounts receivable, inventory are all under current assets. Long-term assets can be tangible assets and intangible assets. Similarly, liabilities are current liabilities, intermediate liabilities and long-term liabilities. But under liabilities, can you see the main thing is debt? Sorry, this is not long-term, it is intermediate. Right. So intermediate debts and long-term debts. So non-debt obligations can be anything. All expenditures like your salary, repairs, bills and whatever other bonuses that you need to pay for your employee. Any other expenditure other than loan will come under non-debt expenditure. Right. So again here can you see, if assets are more than liabilities, then it is net worth or equity of the company. We say that the company is in net worth, or the company's net worth is good, or the equity is nice. But if the liabilities are more than the assets, then we say it is net deficit. I hope this is clear. Types are clear. So what is break-even analysis? The next type of financial statement analysis is break-even analysis, right? So it's a short run analysis of cost, volume and profit. See, we are talking something about a company. I think it is very, very important that you understand that we are talking from the point of view of a company, right? So here there are three things. There is a company, its cost is there, then its volume is there. Volume means volume of production, how much quantity we are producing, and profit. So what is the formula for profit? Income minus expenditure, right? So how will you calculate income? It is volume produced into price of the commodity, right? So again, can you see profit is dependent on volume of production, and volume of production itself is also under the analysis, and cost is nothing but expenditure, expenses. So when we combine these three things and analyze them together, we will do something known as break-even analysis. We will see what we do under this analysis in depth. But before that, there are some assumptions that we have to keep. So what are those assumptions? The first assumption is that constant factor price. Constant factor means factor prices is nothing but input prices, input or raw materials, right? So there is constant input price. In the raw materials price do not change. That is one assumption. Then constant technology, the level of efficiency. See, if technology becomes better, right, then efficiency will become better of production. If efficiency increases, productivity increases. If productivity increases, we will produce more output, correct? But here what are we assuming? We are assuming constant technology. So it means level of efficiency is constant. Level of efficiency you can add of production is constant. And constant selling prices, this can be your MRP. So the price of the product is constant. We are not going to change, right? So these three are the major assumptions that we are going to do. So now what is break-even point? Under the break-even analysis, there is an important concept of break-even point. What does it mean? So in break-even point, we say it is the level of, it is a point of no loss, no profit, right? So at break-even point, let us say some company is producing Q quantity. At Q quantity, there is no loss, no profit. So when is there no loss, no profit? When revenue is equal to expenditure. So at the point where the amount that the company is earning is equal to the amount that the company is spending, we call it as break-even point. Breaking even, if I state the company is breaking even, that means there is no profit, no loss. So you need to understand, in the life of a company, let us say a company was started in 2023. In 2023 only there will be no profit. You need to understand this. The company in the beginning days, it will always be in loss. Loss means what? Expenditure is more than income, right? So the company is in like this state because it has to become famous, it has to become popular, it has to build a consumer base. So much work is there. In this much work, yes, sales will be happening, but it won't be happening enough to make profits, right? So now what are we going to do here is, let us say, right? So in this state, it is always in loss in the beginning, and then when it is in loss, finally let us say it became very popular and it started getting more sales, then it will reach its break-even point. Break-even point means what? Expenditure is equal to income. So this is a very, very important point because it means company is moving forward, correct? From loss it is moving forward to break-even point. After break-even point, we all of us know that it will start earning profits. So in many companies it is celebrated. When the company reaches break-even point, it is announced to its employees and everybody celebrates because you know it is a sign that the company is moving forward, like it is progressing. Otherwise, if it always stays in loss, right, then it is a problem. So again, one more thing I would like to clarify here, it is a production level, right? So production level means what? It is some amount of quantity. It is a quantity calculation. The break even point is a quantity calculation where profit or loss does not exist, or income is equal to expenditure. So we are talking about some quantity of goods or service that is provided. This you should keep in mind. It's not some imaginary point. We are going to measure the quantity of production and then we will say, okay, now I am producing this much. When I am producing this much, I am earning neither profit nor loss. So how do we estimate it? In a graphical method, let us say you have data of quantity which will be plotted here, and there is data of prices. At various prices, you are selling various quantities which is plotted, and then you plot the total revenue curve, total cost curve, and we all know fixed cost is a horizontal line parallel to x-axis because it does not depend on the level of production, right? So fixed cost is, even if you are producing 0 or if you are producing maximum amount, the fixed cost will remain same. So that's why it is horizontal. There is total revenue curve, there is total cost curve. The point where these intersect, can you see this point? And the corresponding quantity and price. The corresponding quantity, what is the quantity here? Q1. This is the break even quantity or the break even point. Because at this quantity, at Q1, there is neither loss nor profit. So we can say the company has moved from loss making to it is going to sustain itself. Now what is the profit area and loss area? Now let us take an example. Let us say Q2, right? So here can you see this is Q2 at price P1. Can you see here total costs is this much, total profit, total revenue is this much. Let us say point A, point B. Can you see that point B is greater than point A? That is cost is greater than revenue. If cost is greater than revenue, what does it mean? It is a loss area. So anything below this break even quantity is going to give you loss. But now let us consider Q3 here, right? So at this point, can you see, let us say this is point C, this is point D. C is greater than D, that is revenue is greater than cost. Oh sorry, this is cost. Revenue is greater than cost, that means it is profit. So any quantity after the break even point is going to give you profit, right? So this is the meaning. I hope the graph is clear. So the point of intersection of total revenue curve and total cost curve is going to give you the break even point. Is that clear? You can write that down. I think it is written in the slide also. The point of intersection of total revenue and total cost curve is your break even point. What is the algebraic method? So in the algebraic method there is a formula. This formula is very important. So what is the formula? Break even point is F by P minus V. So your F is your fixed cost, P is price per unit, V is variable cost per unit. This you should not forget, right? So P is price per unit, V is variable cost per unit. So the formula is F by P minus V. Now there are two words that you have to know: margin of safety, angle of incidence. Now margin of safety is nothing but total output, that is current output. How much the company is producing right now, that is the total output. It is the present production of the company minus the output at break even point. Can you see this is the break even point because the total cost curve and total revenue curve are intersecting here. So the quantity here is Q1. So our output at BEP is Q1. But what is the actual production? It is Q2. Can you see it is higher? So Q2 minus Q1 will give you your margin of safety. This is your margin of safety, right? So what do you mean by margin of safety? It means the company has that much margin where it is safe even if little loss happens, because it is producing more than the break even point. It is in an area of profit. Even if little loss occurs, it is okay. So that's why we call it as margin of safety. Now what is angle of incidence? Angle between total cost curve and total revenue curve. Wider angle means higher margin of safety. So can you see this angle? Sorry. This is the total cost curve, this is the total revenue curve, this is the angle between them. So that is known as angle of incidence. The wider the angle means the obtuser the angle, higher the margin of safety, right? So these are two very important terms that you need to know. Now we are going to start ratio analysis, right? So there are 7 ratios that you need to know. Well, the first one is current ratio. So what is the formula for the current ratio? Total current assets by total current liabilities, right? So it indicates capacity of farm or firm to meet immediate financial obligations. Immediately, if there is some expenditure, is it going to be able to pay it? Is it going to be able to sustain, right? It reflects liquidity within 1 year's time. So it is calculated for 1 year. Value of more than 1 is very favorable, right? So value more than 1 means what? When you have value more than 1, the numerator is greater than denominator. This is when value is more than 1, right? So here numerator is what? Current assets. It should be greater than current liabilities. Then only value will be greater than 1. If assets are more, like I told you, because they are positives, it is always good having more assets, right? So here when the value is more than 1, it is very helpful, or it is a very good sign that the company is doing very well. So when value is less than 1, it is unfavorable. That means liabilities are more than assets. This is not good for any firm, right? So there will be lot of repercussions, right? So loans will become difficult, handling everyday expenditures will become difficult, that sort of issues, right? So this is current ratio. The next ratio that we are going to do is one second. Right, next ratio we are going to do is intermediate ratio. Intermediate ratio is, sorry, there is an is equal to here, total current assets plus total intermediate assets divided by total current liabilities plus total intermediate liabilities. So here we are going to check the liquidity for 2 to 5 years, right? If the time period you are checking for is 2 to 5 years, you need to use this ratio. If you are checking for only 1 year, you need to use current ratio. That is the difference, okay? So value more than 1 is always favorable. Here also value should be more than 1, but here can you see, because time period is more, right? It is 2 to 5 years means there is almost, you are checking the value for 3 years of time. So 3 years is a long time. If in 3 years, if you get the value as more than 1, it means the business is very steady. It is growing very healthily, right? Then what is net capital ratio? Net capital ratio is very important. Total assets by total liabilities, right? It indicates how much money the person has immediately. For example, if I have a business and my NCR is more than 1, that means assets are more than liabilities, and immediately I feel like selling my business. Because I have more assets, I will get more money when I sell, right? Because assets are more, liabilities are less. Liabilities means your debt and other expenditures. Because my debt is less, my loans are less, my other expenditures are less, my assets are more. Assets means money I am getting from outside is more. That means profit will be more. So I can conclude that mine is a profit making business. But now I want to sell that business. If you want to sell a profit making business, you will get more money in return for it. Correct? When you sell a very good high class working condition phone, you will get more money. But when you sell a broken phone which can do only 1 or 2 operations, you will get less money. Correct? Same idea. When you sell a business which is making more profit, you will get more money. But when you sell a business which is not making so much profit, you will get less money. So solvency means money obtained when business is stopped or sold or dissolved. Dissolved means the business runs no more, right? You dissolve the company, you tell everyone that the company will be no more and all those things. When you do this, you will get more money in return, right? So that is the meaning of solvency position. I am putting farmers here because we are studying ABM. We are always going to talk with respect to farmers and their businesses, okay? So value of more than one means funds of the firm or farm are safe. Firm or farm with higher value of this ratio should be a prompt repayer of all his loans. See, this is very important. When your NCR is more than 1, that means profits are increasing. They are high. When you have more profits, if you don't repay loan, what does it mean? That means you are not doing it by mistake or you are not doing it because you don't have money, you are doing it purposefully. Then that will become a very bad thing. That shouldn't be the case, right? Okay. Then what is acid test ratio or quick ratio? So when we say acid test ratio, the formula is cash receipts plus accounts receivable plus marketable security divided by total current liabilities, right? So cash receipts is how much money the company can get. Accounts receivable is how much money other people have told that they will give the money. Marketable security is all the bonds and equity and the shares that the company has, right? So indicates adequacy of cash and income surplus to cover all current liabilities during a period of 1 or 2 years. So this acid test ratio or quick ratio is checking whether the company has income enough to cover current liabilities. Current means immediate liabilities for 1 or 2 years. That means in the 1 or 2 years, can the company stand on its own? Is it having enough money to, cover its current liabilities? If it is yes, then it becomes a very good thing, right? It can be told that the company is running very healthily. Current liability ratio. See, current asset we saw. Now, what is current liability ratio? Current liability divided by owner's equity. So, again I have told you equity is nothing but net worth. So, when do we say it is net worth? When assets are more than liabilities, we say it is net worth, right? So, it indicates firm or firm's financial obligation against the net worth. That means how much money in the net worth will go away as current liabilities, right? So, now let us understand with an example. Let us say a firm has assets equal to 10,000 rupees and its liabilities are 2,000 rupees, right? So, what is its net worth? Assets are more than liabilities by 8,000 rupees, right? So, this is its net worth. So, what is current liability ratio? Current liability, that is 2,000 rupees by 8,000. So, which is 1 by 4, which is 0.25. Can you see here it is less than 1? So, whenever current liability ratio is less than 1, it is a good sign. Because we are talking about debts, we are talking about loans, we are talking about money that the company has to repay to others, right? So, as much as possible, if it is less than 1, it is very, very good. And as and when the company grows, the current liability ratio should become lesser and lesser than 1. If it is negative, it is even more beneficial, right? Negative means there is no liabilities, everything is assets, that is the meaning. Debt equity ratio. So, what is debt equity ratio, or it is also known as leverage ratio? It is total debts by owner's equity. See, liability ratio is considering all liabilities. All liabilities means your debt liabilities plus non-debt liabilities, right? So, that is current liability. But here can you see there is only debts. Non-debt expenditures are removed and only debts is considered to divided by owner's equity. This will show how much capital or how much money that is present in the business is loan money and it is own money, right? It will give you that quantity. So, even here when it is less than 1, it is very, very good, because if it is more, then it will say that more money that is present in a company is loan or it is a debt. It is not the profit money or the sales money of the company, but it is the debt money, right? But if the ratio is less than 1, it will be shown that it is the company's own money. Okay. Now, what is equity value ratio? Equity value ratio is owner's equity divided by value of assets. See, it is not ratio. Okay, you can remove that. Owner's equity divided by value of assets. It will always show you by using this much assets, how much equity am I getting. By using more assets, am I getting less equity? That is bad. See, equity means net worth. Net worth is something when assets are more than liabilities. When you have more assets, you should get more money from it because you should be more productive. But if you are getting less money, then it is a bad thing. So, this is a very, very good ratio to check the growth of the company, right? Now, what is SWOT analysis? SWOT analysis is very, very important. It is done to assess how the company is working, where are we going wrong, and what should we do better, right? This is known as SWOT analysis. So, in SWOT analysis, the expansion is strength, weakness, opportunity and threat. So, SWOT, it has all these expansions. These two, the strength and weaknesses, are internal variables. The opportunities and threats are external variables. That you should remember. That is very, very important, right? So, this is internal variable, this is external variable, right? So, now what is the strength? Strength means what the organization excels at, what sets it apart from the competition, right? What is it the best at? What is where you get that in this organization, you don't get it anywhere else. That is the strength, right? It can be R&D, it can be the working culture, it can be the salary, it can be the product itself, anything can be the strength of the company. If everything is the strength of the company, then it's great, but it's not usually like that. It has some weaknesses. So, weaknesses is where so this is the S in the SWOT, this is the W in the SWOT. So, W weakness means somewhere the company has a weak link due to which it is not able to realize its full potential, right? So, that is the weak link. It can be a bad brand. Bad brand means maybe, well, you know, yesterday we studied brand design. It should be based on market research, what consumers want, etc. like that. Maybe they didn't do enough market research. Now they have a bad brand. Enough sales are not happening, so no profit. That is a weakness, right? Then high levels of debt. Like I told you, in that debt ratio, we can see how much money is debt money, how much money is company's money, right? So, if there is high debt, at some point you have to repay, but to repay you are not earning enough money, then it will become a very bad thing. Inadequate supply chain, lack of cash, all these things are weaknesses. So, what is opportunity? Opportunity is nothing but various advantages that the company can take from outside. It's an external thing. Opportunities won't come from inside the company. They are always in the outside of the company, right? So, like they said, like there's a saying, you should see the silver lining in every situation. Silver lining means what? The positivity. You should see the opportunity in every situation. If you learn to do that, then you can run any business very nicely, even in times of distress, right? So let us say the opportunity is that a company is producing apparels, that is textiles, and it is going very well. People love its apparels, and suddenly there is a shoe company which wants to sell its company, right? It wants to sell because they are not able to handle that company. Now this apparel company has enough money to buy this, and you obviously, we know apparels and shoes goes together. This already has a good brand. They can buy this company for less money and convert it into their brand image, and they can sell it as saying, both buy shoes and apparels which match together or something like that. They can create a brand which is very, very helpful, right? So it is an opportunity. So there are many opportunities like this. Company has to take care. What are threats? Threats are something that can harm the company financially or destabilize it or anything like that, right? So external threats are always external. Internal threats are also sometime there, like information leakage and all, but not very prominent. Okay. So when we say threat, it can be war, it can be supply chain disruption, high tax immediately from the government, change in business structure, change in business laws of the nation, anything like that from externality. But the company should be well built to handle such things, right? So today we did financial statement analysis, we did assets liabilities, we did ratio analysis, and we did SWOT analysis, right? So that's it for today's, guys. This has been your 3 agribusiness management marathon sessions. I hope I have been able to cover some major topics that was required for the exam. From next time, we are going to take a deeper dive into all the topics for sure. I hope you all had a very nice session, and I wish you all the best. Please continue working hard and studying for the exam. Have a very good day. Thank you.